papers today and begin with the paper presented by Professor Park on developments in Korea. And so if you would like to proceed,
okay.
Thank you very much.
Okay, thank you very much. One of the authors of this paper is Thorsten Beck, but his contribution is not included in this the preliminary draft, not because he didn't do his work, but because we failed to deliver our paper in time for him to contribute a section. But then after the conference, I'm sure he will help us edit this book, which it looks pretty bad at this stage, and he will add one section to our paper. I will skip this overview stuff, and then I will begin with this growth and diversification of fintech industry in Korea. Well, my frustration in working on this fintech industry in Korea is that we don't have an official definition of fintech firm. We don't know what it is. And there are no official data on the number and functional classification of fintech businesses. And our estimate, which is our preliminary estimate, is that there are about 800 fintech firms in Korea operating in different types of businesses, fintech businesses, and most of these firms are very small, the startups, and in many cases we don't know whether they should be classified as financial firms or technology firms or something else. But nevertheless, the financial authorities classify fintech firms into 10 different categories, but the largest one is payment and the settlement, as shown in the appendix of these presentations. In our presentation, and from policy perspectives, there are basically 4 categories of fintech firms that matter very much for policy prescription in this country. One is the electronic financial businesses, and there are about 152 business firms engaged in all sorts of payment and settlement services. And out of 152, 104 are small fintech firms. Remaining 40 firms are the non-bank financial institutions, big businesses, and online platform companies, and big IT firms. And then the second one is the P2P lending firms. At the end of 2019, there were 240 P2P firms. But now the recent regulations will require all of these firms to register, and then we'll see how many firms will be able to survive and the new test imposed on these firms to qualify for the P2P. And then the crowdfunding intermediaries, there are 14, but then some of these crowdfunding firms have failed, and the volume of business conducted by these crowdfunding, the intermediaries have been rising very, very fast. And to me and to many people, there seems to be not much difference between P2P and crowdfunding in this country. And then there are financial platforms consisting of 2 very large ones and 50 very small ones. And then, just a minute. Why is this? Why is not, this thing is not working? Okay, and now then I'm going to discuss basically 2 types of the fintech firms. One is the electronic finance business, which I consider is a success story. And the other one is a P2P, which is a total failure. What is interesting is that since the introduction of electronic finance business, the industry has grown very rapidly. In fact, between 2008, when they started the business, and 2020 second quarter, the volume has risen by more than fivefold, and the number of uses has increased by tenfold. It's very rapid growth of this industry. And what about the regulation of the fintech firms? The regulation of the electronic financial business? It is regulated by Electronic Financial Transaction Act, what is known as EFTA, which is legislated in 2007 and amended in 2020. Now, the important aspect of this the Act EFTA is that any entity is qualified to apply for a license to engage in payment and settlement business, so that the Korea Rail Company has also a license to provide payment and settlement services, and there are many non-financial firms which operate as electronic financial business firm. The EFTA was amended in 2020, and I'd like to point out some of the major policy initiatives contained in this amendment. It contains a liberalization as well as regulatory measures. One important measure is that the so-called designation of one-stop multiple payment service will allow these fintech firms to take a deposit. Well, not a limited amount of deposit. Nevertheless, for the first time, they will be allowed to take deposits, so that fintech firms can lend, can take deposits, can offer all kinds of services other than payment and settlement. Now that tells me what are these the fintech firms? Are they the banking institutions or some sort of quasi-banking institution? What are they? I mean, this is one of the questions. And the flexibility of the Electronic Financial Transaction Act is going to cause a lot of problem in regulating fintech industry in the future, as I'm going to discuss later on. And then the liberalization measure also allowed access of these the electronic finance business firms to central bank settlement network, and that is the major change. But at the same time, the initiative includes one regulation of the financial activities of the big tech firms. And again, here I have to admit that there is no definition of what big tech. We don't know what big tech is, but then the financial authorities tell me that there are only two big techs, and I will go over the big tech a little bit later on. Now, what about the second most important development in the fintech industry? That is the P2P lending, which has been a complete failure. The industry has been dominated by the money lenders, former informal money lenders, converted themselves into P2P firms to obtain some sort of credibility and respectability, I suppose. And then they are all registered with local governments, not with any regulatory authorities, and regulated very lightly by money lending law. Now, the borrowers are mostly the small and medium-sized enterprises and households, and almost 70% of borrowers have had in the new survey had credit ratings below what we consider triple B, and they have all limited access to the bank loan market and paying 15 to 26% interest rate per year. And then beginning in 2015, the regulatory authorities found the increasing number of the P2P firms going bankrupt, and then they were receiving all sorts of reports indicating that they were engaged in all sorts of illegal activities. In fact, when they were introduced in 2006, there were only 27, but by March 18, 2020, when they were all of these P2P were inspected by the Financial Supervisory Service, there were 242. And between 2017 and 2020 March, the volume of lending went up by 570% over a little bit more than 3-year period. And then lending default rate went up from 5.5% to 15.8%, which means almost 60%, tripled. And obviously that the regulatory authorities were very much frightened. And their inspection suggests that many of these P2P firms were engaged in fraud, the Ponzi scheme, and other illegal activities. And that this sad state of the industry required regulatory authority to enact what is known as the P2P Act in August 2020. Now, the only 78 out of 237 P2P firms inspected by the FSS, Financial Supervisory Service, they filed proper audit reports, and only 10 of these firms would qualify registration under the new P2P Act. And in fact, Korea is the first country in the world introducing a P2P law. Now, the regulation of the fintech industry, there are 4 major regulatory issues. One is that different fintech firms are regulated by the government bodies, including Financial Supervisory, the Commission, which is the main the supervisory institution in Korea. And many of the financial market supporting fintech firms are not regulated at all. And the number of the financial market supporting firms is estimated to be anywhere from 150 to 100. And there is clear need to streamline existing and shadow regulations and other pre-existing regulations under different ministries of jurisdictions. The FSC has been trying to streamline, but then it's not going to be very easy, and it's going to take many, many years to come. And then finally, what is the basic problem of with this regulatory system is that the limitation of applying existing regulatory system created for incumbent financial firms to fintech regulations. And this has required to enact new law after new law, and they will continue to legislate different type of laws governing different types of fintech firms in the future. Now, on the question of what regulatory authorities, what regulatory authorities have done in terms of regulatory interventions. Well, they intervened only when they saw the need to manage market risk arising from the growth of the category of fintech firms. And the first time in 2007, because of the large increase in the fintech firms offering payment and settlement services, that the financial regulatory authorities had to legalize their activities. And that was in 2007. And 13 years later, and they introduced amendments to EFTA, and then also they introduced or enacted new P2P law in 2020. And there is going to be the continuing need for regulating. There will be need to regulate big tech and financial platforms and the crowdfunding the intermediaries as well, which means that in the future, at least they will have to legalize the activities of these three different entities: big techs, financial platforms, and the crowdfunding intermediaries, simply because they have created some of the problems that could destabilize the financial markets, destabilize financial market stability. Now then, there is another regulation, the legislation that the industry needs is the sandbox program. Right now, there is 103 products and services are now included in the sandbox. And then the problem with this sandbox program is that after leaving this sandbox, there is no arrangement or law allowing these services or products to be marketed. In other words, that if services or products are supposed to be determined to be innovative new products, and then the producer of these services and the services and products should be able to market them, but then there is no allowing them to sell these products on the market, so that they will have to have another regulations. So which means that in coming years, I see that there will be at least 3 or 4 more legislations to deal with the growing problems in some of these fintech industries. And then how much time more, Steve, how much more time do I have?
I think 3 or 4 more minutes would be good.
Well, I'll just spend we were going to do some empirical work on the efficiency of financial digitalization and efficiency of the financial sector, and I'll spend a few minutes on this. One, as a result of the financial digitalization in the banking industry, many people expect that the bank branch network will shrink substantially. And then there has been a substantial, there has been a decrease in the size of the network from 2010 to 2020, but then the only about 17 or 18% decrease. It's much smaller than what is expected. And simply because the banks are still engaged in retail and mortgage lending so much that they need a larger branch network. And another thing is the interesting, I don't know whether it is interesting from the perspective of this discussion is that net interest margin of major banks, that have not changed very much. Have not very much, and except this Kookmin Bank, which is specialized in retail banking, the net interest margin been very stable and very similar among remaining three banks. And then another interesting development is that the NIM for internet banks, two internet banks created in recent years, the K Bank and Kakao Bank's names were much higher, substantially higher than the NIMs of the major banks, four major banks, which control 80% of the commercial bank assets. And I think it's something to do with this oligopolic market structure of banking industry. And then another one is that about three years ago, one FinTech firm announced that it was going to offer remittance fee 1/10 of what banks were charging at that time, remittance to the G20 countries. As a result of this substantial decrease in the remittance fee, now the Korea is the second lowest in terms of remittance cost, remittance fee, remittance to other G20, the country. I think this is visible evidence suggesting that the FinTech development has contributed to reducing some cost of financial services. And then we have two macroeconomic indicators. We see that, for instance, labor productivity has increased substantially from, for instance, in the early 2000, it was about 6%, but now it is almost 14%. It's a substantial increase. And then the unit cost of intermediation has steadily declined from more than 2.5%, now a little bit over 1.5%. And initially, we were going to do some empirical study linking these changes with the FinTech development, but simply because of the lack of data points, and we have not been able to do. And I cannot tell you whether these developments have anything to do with financial digitalization and the expansion of growth and expansion of FinTech industry. Nevertheless, we see substantial increase in the labor productivity in the financial industry, as well as substantial reduction in the cost of intermediation. But then this cost of intermediation is the one that developed by the Philippon. And I have some difficulty with this definition, because the intermediation asset, which is used for calculation, contains M2, so that whenever there is a substantial increase in the M2, this cost of intermediation is likely to go down. So that there has to be, one has to make some kind of adjustment in estimating this cost of intermediation. Okay, thank you. This is the end of my presentation. Thank you very much.
Thank you very much for the very nice, comprehensive presentation on the state of the FinTech industry in Korea. I'm sure everyone found it very informative. We have two discussants. Each one of them is Torsten Beck, and the other one is Duhan Song. Dr. Song, would you like to start for about 10 minutes?
Yeah, hello, sir. My name is, are you hear me?
Yes, we can hear you just fine. Do you have slides?
Okay. My name is Duhan Song, and currently working as a senior researcher in NH Financial Research Institute. First of all, thanks to the Professor Park for the presentation comprising all of aspects of the FinTech industry. During the presentation, I had an opportunity to learn what's going on digital innovation of the banking industry. Personally, I totally agree with the Park's evaluation of the FinTech industry, but I briefly make comment on what I feel during the presentation. First, I want to discuss about what caused the slowdown of financial innovation in Korea. Professor Park argued in his paper that Korean banking industry lagged behind in digital innovation in terms of speed and strength, mainly due to the oligopolistic market structure. I believe it maybe not. In Korea, we just have 7 major commercial banks, but if you take a look at the Hapindul-Hushman index, sort of the concentration ratio, as shown in the page 8 in his paper, number for the banking industry is less than 1,700, which is not that actually significant. In that sense, I cannot say that the market structure is the main cause undermining digital innovation of the banking industry. I believe the main reason is related to the policy interest rate that keeps slowing down since 2008 global financial crisis. Right before the recent financial crisis, the NIM, the NIM for the Korean bank was more or less 3%, which quite a promising number. Under such an interest setting, the Korean bank don't have any need for the digital transformation because of stable income from the traditional banking business. But as you know, the policy interest rate has been keep going down to 0.5% in Korea. And in the meantime, the NIM, NIM for the banking decreased to just 1.4%. Furthermore, many professionals predict such a low level of interest rate might be continued for extended period of time. In this situation, there is no way for the commercial bank to avoid the paradigm change to the digital transformation. That's the reason why many Korean commercial banks engage in intense competition to stimulate digital transformation. I personally believe the commercial banks' approach to the digital innovation in Korea is considered to be very aggressive as compared to what they did just several years ago. I just make just one more comment and finish my my word. This time, I want to make comment on the comparative structure Professor Park mentioned in his presentation. First of all, the relation between the commercial bank and fintech firm are complementary rather than the substitute. That's what I think about. At the initial stage of the fintech development, the bank and fintech firm compete to dominate service platform, but they both realize that the cooperation is the win-win strategy each other. Specifically, since most of the fintech firms don't have their own customer database, they need to depend on the bank database. And commercial banks in Korea are also willing to provide open platform in which fintech firms develop financial service the bank cannot provide. There are many cases supporting this. For example, fintech firms such as TOS and Bank Salad in Korean fintech firm cooperate with bank and provide various financial services. In this respect, the competition between bank and fintech is not the major factor that undermine the development of fintech industry. What I'm trying to say is that the both commercial bank and fintech can go hand in hand. So we need to pay more attention to the big tech rather than the fintech. But that's my final comment. Thank you.
Thank you very much. That's a very useful perspective for us. Torsten Beck is the second discussant. Torsten, do you have some slides?
No, thank you. I don't have slides. Okay. I just have some remarks. Actually, my remarks are to a large extent questions rather than comments. So the first kind of general question, that's not a question for Jung Chul, but for Professor Park, sorry, but more as a kind of background question. What would we actually expect in terms of fintech development in Korea? We know there are both demand and supply side kind of factors that can explain the the emergence of a fintech industry or even the entry of big tech, as for example the work by Leonardo that we saw yesterday refers to. Now, if I understand correctly, Korea is a very developed, has a very developed banking system. Yes, it is maybe concentrated, but then again, I mean, there are many advanced financial systems, for example, also in Europe that are relatively concentrated, such as the UK, for example. So where are the gaps? I mean, again, if I compare the UK with Korea, the UK clearly has a gap in credit provision to SMEs, for example. Especially since the global financial crisis. The UK clearly has a gap when it comes to payment services, given these terrible legacy IT systems of the big four, big five here in the UK. So there's very specific reasons why in the payment, but also in the P2P lending area, there is a lot of entry of new providers here in the UK, for example. So my first question would be, what about Korea? Where are the gaps? Where can new entrants have an advantage vis-a-vis incumbent banks? For example, the big four, big five in Korea. Can they offer better processing of applications, for example, of data? Can they offer better, more effective payment solutions? Now, Professor Park kind of very nicely described these different segments of the fintech landscape in Korea. But I just wonder, again, in the form of question, what about challenger banks? I mean, are there new entrants, just regular banks, maybe internet banks, but also just regular banks? So as we have them, for example, here in the UK with Metro Bank. And are they are there barriers to the entry of such new providers? What about consumer credit firms? So what we can see, for example, in many Latin American countries are kind of credit companies that link with department stores and provide credit facilities. Some of them eventually turn into a bank, such as Banco Azteca in Mexico, for example. But some of them also just stay on the credit side. So that's kind of just to get a bigger picture of what else is out there, and in turn, what would be the gaps. And I found it very interesting, the discussion on the EFTA, the Electronic Transfer Pricing Act. And my question would be, what is the effect on pricing? Now, of course, we have Antonio here who knows much more about this area than I do. But so what is the, I mean, one of the problems that we see often in payment are these very high fees. For example, switching fees, the credit card fees. Has there been any effect of the extension of allowing new entry in this space, new innovation in terms of pricing for customer, for the benefit of customers? Now turning to the P2P lenders. So here there seems to be a very interesting phenomenon, very different from other countries. So if I understood correctly, Professor Park, then there is, these are basically former money lenders that kind of went into the P2P space. But then the question is, are these actually P2P in a sense? Who are the investors? I mean, who puts their money into these P2P forms? And is the problem on the investor side? So are the investors being cheated out of their money, or is it really on the borrower side, with maybe high interest rates or kind of odd recovery tactics? And again, who would they? I mean, it makes, again, referring to what I said earlier, it would make sense, of course, if these informal lenders already existed. And if they cater to a specific market segment that is not being served by banks, that this would be also an area where P2P lenders ultimately show up. Now, my final comment, and this is not a question but a comment, on the interpretation of the net interest margins. So they are, and it doesn't matter whether you look at spreads or margin. So spreads are kind of the ex-ante interest rates that are being either paid to depositors or charged to borrowers. Net interest margins are kind of what we get from the balance sheet and the income statements of banks in terms of revenue and interest costs. And they are very important in composition effects. So for example, if these internet banks have higher net interest margins, this might be partly due to competition effect indeed, but it might also be part to composition effects, in the sense that they charge higher interest rates to their borrowers because these are riskier borrowers. So that might be one reason. And it's very difficult to actually get to clear measures, clearly comparable measures between interest rates of different banks, because you would have to hold constant the risk profile of the individual borrower. And ultimately, the only way to really do this is to go to credit registry data, where you can look at kind of within borrower variation across different types of financial institutions. So overall, I find it's a very interesting paper, and there are very few papers like this out there that look at the fintech landscape in the specific country. So I really like it very much, and I'm not saying this because I will be a co-author, but also because of all the great work you have been already doing. And so I just have some additional questions, and of course I know that some of these questions might be hard to answer given data availability, and formal econometric tests might not be possible. So it might be more an issue of working with anecdotes or with some kind of correlations rather than establishing causality from from hypothesized cause to hypothesized effect. So let me stop here. Thank you very much, Steve.
Thank you very much, Torsten. Thanks to both of you. Are there questions or comments from anyone else? I have a few, but I will wait. Andre, would you like to start, and then Antonio?
Yes, I thank you very much. Fascinating. I really learned a lot from the presentation. Really, really interesting. My question is there anything in the Korean fintech that is, in your opinion, specific to Korea? Because P2P, challenger banks, payment services providers, these are sort of global phenomena driven by sort of existing digital technologies that are just sort of being, it's like a technology transfer into the Korean financial system. Is there something specific to Korea that you find is a sort of serving specific needs? Sometimes it's interesting to look at the things. For example, in pick another country, I was looking at the fintech industry in Spain, and they have something interesting in sort of a real estate space, where they have sort of fintech combined with real estate. You can own sort of a fractional portfolio of real estate holdings because it's just very expensive otherwise to actually have exposure to real estate. And there are very few assets in Spain in which you can actually have an exposure to Spain if you're in Spain. So something like that, something that has a Korean fintech flavor. Thank you very much.
Thank you, Antonio. And then Xavier, do you have a comment as well?
Yeah, I just had a quick question. You were talking a lot about regulation of fintech companies, but I was wondering as well, how did the regulation of the incumbents has changed to allow fintech companies to enter markets? In particular, I'm thinking in the payments service sector, how interoperability has allowed small players to come into payments. I believe Korea has a system of QR codes like other countries around the world, and to what extent that has facilitated entry of small players to access the infrastructure of payments at a fairly low cost. And I don't know what the cost would be to enter that segment by a small player.
Thank you. Xavier?
Yeah, also it's related to, I think, what Andre was pointing out. To what extent the P2P experience in Korea is extrapolable to you think, not to other countries? In particular, the evolution, the type, the different types which are evolving, the evolution of defaults, whether in the end this will be a sector which will become much more like regular intermediaries or not. So, I mean, I have some strong priors on that, but I would like to, I would like to know your opinion.
Thank you. I guess I could echo some of the comments made by some of our colleagues here. I do have a few questions. Well, certainly on the P2P lending, as Xavier said, I have some strong priors. We're seeing the developments in the United States actually as P2P lenders just become more and more like standard intermediaries. And as they discover the adverse selection problems that exist at very high interest rates. And so I guess one of the questions about the P2P lending space in Korea whether the problems were associated, as I think Torsten Andre also suggested, with some combination of failures of investor or consumer protection requirements for these people. And so the problem was just simply a lack of regulation. My biggest question is whether or not there's any way to think about, for you in Korea, in the context of your legal system, to think about activity-based regulation. So if somebody does something, you write your regulations in terms of their activities, and you say if you're involved in providing this service, then this is what the regulatory environment looks like, and you have to have a particular license or meet some requirements. A second, more slightly smaller thing that's related to some of the discussions we had yesterday is about deposit-taking institutions, their access to deposit insurance, and their access to the lender of last resort. Consumers generally feel, in my impression, this is not true in every culture, but consumers basically believe that their deposits are somehow liquid. In general, that seems to be a normal sort of approach. And if you're going to offer liquid deposits, then the question is whether or not you become a runnable institution. And if you're runnable, then you have to have access to the lender of last resort for financial stability. So whether or not that's being offered in the Korean context, I could make a number of other small comments, but I can send those separately. Would you like to have a few minutes to respond, Professor Park?
Okay. There are too many excellent comments, and I appreciate very much all these the comments. Let me begin with the P2P question. P2P lenders, the operators, were paying investors very high interest rate, something like more than 10%, so that they were able to raise substantial amount of funds. You know, when you are depositing money at the bank, you receive less than 2% per annum. Well, they're offering more than 10% interest per year, so that they were able to raise substantial amount of money to lend. But then in lending, they'll have to earn much more than 10%, in fact, almost 20%, so that they are charging 20% to the borrowers, anywhere from 15 to 20% to borrowers, without proper the credit evaluation, or without taking any kind of collateral in many cases, so that many of these borrowers were not able to repay their loans. And when they saw that the delinquency rate start rising, what they did was that whenever they have a new investor coming in, and then they were making up the losses arising from this the failure of some of these borrowers who could not repay. And so that there was this, the Ponzi game was going on. And at the same time, there were some of these, the P2P lenders, when they were faced with a growing default rate, they simply closed and ran away, just simply disappeared. And the question is why we have attracted so many the operators. It's not clear, and but nevertheless, that is what happened. And in fact, realizing the problems in 2016, around that time, the Financial Supervisory Commission issued some sort of guidelines for the P2P activities. But then these sleazy lenders completely ignore these the guidelines, and guidelines were totally useless. That's why they had to impose a tougher regulation on these lenders. So that the problem has been on the side of lending, not on the side of investment. These guys didn't have any problem raising funds. Well, they were paying 10%, and whenever they could not repay these investors, always they find a new investor coming in and then made it up, this Ponzi game thing. And so my problem with this thing is, why in this country this particular industry has attracted so many people who are prone to conducting illegal lending activities, committing illegal activities. This is the basic the problem. And then when the EFTA was legislated, one of the objectives was, I was told that the financial authorities wanted to put pressure on these banks so that they could lower their fees and at the same time improve the competitive structure. In other words, they don't want to relax entry requirements, but then by creating the new industry specialized in payment and the settlement, they thought that they could put pressure on the banking industries so that they would be a little bit more the competitive vis-a-vis these the entities engaged in electric finance business. And in fact, there has been any change in the existing laws and regulations apply to incumbent financial institutions. And then this EFTA is going to create lots of problems simply because in the future, I mean, it's going to intensify competition vis-a-vis banking institutions in the sense that, as I indicated, many of these fintech firms, including big tech and financial platforms, will be acting like a bank. They can take deposit, they can lend, they can provide all kinds of financial services. And in fact, there are no regulations, as far as I know, limiting their financial activities. And then we've been looking into these 200 the unclassifiable fintechs, and I look into them, and then it's difficult to find out exactly what they do. But then many of them are very domestic, and then we could not find any equivalent type of fintech firms elsewhere. In other words, that we were trying to find whether we have the fintech firms similar to those operating in European countries, United States, in the UK, elsewhere. But there are so many of these firms totally domestic, and we'll have to spend more time to find out why they are there and are they making money, and what kind of services, precisely what kind of service they provide. This is the problem. And then as for the banking the sector, well, there are basically two important gaps. One is that the banks are extremely inefficient in providing payment and settlement services, and for that matter, all other services. And that is one reason why many of these new fintech firms have been so successful. This is one. And the second, that the banks have not invested enough to improve their improve their technologies and invest in innovations for a long time. And that, the interesting is that the banks do have an incubator of their own. But then they say that they are spending lots of money and adopting new technologies, but then they are more interested in going to the market and buying up these new promising smaller fintech firms instead of developing their own technologies. And then they say that all these fintech firms need bank financing anyway, so that they can choose whichever the fintech firm they find interesting or profitable in the future, so that the banks continue to rely on existing technology like the mobile banking and the internet banking, which does not require any technology. And then the major glaring gaps are two. One, the low income the household and small-sized enterprises have a very limited access to these banking institutions, and they were served by savings bank and the private lending firms. They are legalized legal lending firms and other the non-bank financial institutions. But then, as you can see in the growth of the P2P, the existing financial institutions, including banks, not been able to meet a growing demand for fund by large segment of the society. And
I think we should probably be wrapping up. Are you
okay.
just about done?
Yes, I'm just about done. Yes.
Okay. Okay, great. Thank you. I think we've gone over a bit. I think we started a bit late, so I think we can we should take a break now if that's agreeable, and we come back in. I guess I think we can afford to come back in 10 minutes. No, 5 minutes. 5 minutes. 5 minutes. Okay, very good.
Thank you, Steve. I need to say that I'll need to check out in about half an hour. It turns out I'm chairing a session.
Okay, thank you very much for your participation, Andre.
Thank you.
Yeah, okay, thanks. So we'll be back in a few minutes. Young-Chul, what you're describing as P2P is not what I think of as P2P lending here. Because here, peer-to-peer lending is where individuals make loans to individuals. Right. And so if there's a default, then the default goes straight through to the lender. And the institution is a platform. It doesn't raise funds. The institution doesn't raise funds. The fintech firm doesn't raise funds. And the fintech firm doesn't make loans. The fintech firm is basically like, it's like a mediator or between the two. I mean, there's still a lot of problems, because the question is whether or not the lenders are aware of the credit risk that's being taken and whether or not the borrowers are properly representing themselves, right? We still have standard screening problems in P2P lending, but what you describe sounds like a bank, where somebody raises money and makes loans.
Lending side, a bit like well, in the US it's the payday lenders. In the UK we had a similar industry, like a short-term consumer credit industry, which ultimately was to a large extent killed by the introduction of usury rates, so like an interest rate cap ultimately. So it seems a bit like that. And of course, there's a big discussion in the UK about the US about this payday lenders. I guess Manju can tell us much more about it, but whether it's positive or negative. But that there's certainly also abuses in that industry, and there's certainly abuses in the credit.
Even in Korea, I mean, they claim that they provide this matching services, but then they receive funding from many different people with the promise of finding appropriate the borrowers. But then when you are receiving so many funds from so many different people and dealing with so many borrowers, and then this one-to-one matching does not always take place. And so that when you have so many lenders and borrowers on both sides, and then they act like a bank. And in the process, if you find that many borrowers are not able to repay their loans, and then who's to take the losses? Well, not certainly the investors. I mean, so that the matchmakers sustained for a while by taking this the Ponzi game for a while, and then after a while, they simply ran away.
Well, in the tradition, in the standard P2P world, the losses belong to the individual lenders,
right?
For sure,
right.
There's no question, and the person in between takes a fee on, like a bank or like anybody. They take a fee for making the match, and that's it. So, I mean, again, there are problems with these things, and there's a question about what they're becoming, because as we've discovered, the thing is that making these loans as an investor, if you will, or a lender, it's extremely tedious to sit there and make like, you know, $10, $100 loans. Because what you do is you take a slice, you diversify. You don't make a loan that's 100% of what anybody wants. But the problem is that this is not, individuals don't have the skills to do this or the time. It's quite time consuming. It's okay if as an entertainment, but it doesn't really work out as an investment. There isn't, it doesn't make any sense to me anyway. And so what's happened is that they've become more and more, what's happening is that they're packaging the loans now, and they're selling shares in loan packages, and they're selling those actually to institutional investors. So so it sort of works, but it doesn't work very well, and it looks just like a banking. It looks like a bank to me, especially because
if you look into their books, I mean, they have the records of matching each individual lender to the borrower. I mean, they have the book, but then it's the falsified record in the sense that it's arbitrary matching. And
it's not on their website. It's not on their website, and
not on their website, except one or two. Well, few of them have their own website, and they have even the guaranteed the payment of principal and interest to some of their larger investors.
Yeah, well, this sounds like loan sharking to me, but I don't. Right. So I don't know what
the question is that in the absence of the regulations or legal law limiting the activities, why this industry has attracted so many sleazy, the unqualified, the matchmakers?
Well, if you let it,
yeah,
I mean.
Exactly.
I think that, you know, Torsten mentioned this payday loan business, which has existed here for many years, and that certainly didn't attract the best quality people. I mean, the scandals. What got them into trouble was they did something very stupid, which was that they set up offices outside of military bases and started offering payday loans at extraordinary interest rates to people in the army. Now, it's one thing to offer it to poor people. that, sort of the politicians don't care very much. But if you start exploiting the military, then you get into trouble. And so all of the laws associated and the regulations associated with P2P lending come from the fact that these people did something stupid as a political matter. But economically, they make tons of money by exploiting poor people.
Right.
And it's not a business that I think very highly of.
Yeah, but I mean,
anyway, we should move on.
Yeah, but just one
if
more
we
question.
can, is that all right? Can we start our second section?
Yeah, just one more question.
Yeah.
I mean, is it right to regulate them out and then leaving only 10 P2P in this country out of 242? Is that right, or is it something desirable or not? I mean, this is the final question.
Well, I don't know.
Yes
I
or
mean,
no?
it depends. I'm not going to tell the Koreans what to do. I mean,
Please do.
There's well, you can tell the Koreans what to do, but we ban. I mean, heroin is illegal, so there's stuff out there that's illegal, and there are financial transactions that are also illegal, and so I think that depending on the social environment that you're in, you could make this stuff illegal. You could just say you can't do it because it breeds this kind of activity. I mean, otherwise, I'm not going to tell you to do that because I have no idea.
I mean, it's a clear case of consumer protection, I would say. And I mean, there's a trade-off, right? I mean, if you basically ban them, they're just going to go back into the informal economy.
Precisely,
right?
that is the problem.
You do it anyway. On the other hand, I mean, if you link it with enforcement, and if you link it with financial education, for example, for people that kind of got kind of addicted to these loans, then maybe there is a way. But there's a certain tension here.
I mean, I would license them, right? So on this, I would license them, and I would very much control their activities.
Yeah, but what would 10 PP to P2P firm will do?
Well, I don't know. I mean, I don't know. They're not very big in this country. I mean, P2P lending is not a huge industry anywhere that I know of. It's a very, very small fraction of the amount of lending that goes on. Okay, let's go to our next paper which is the paper by Torsten Beck, and he has shared. And then we have two discussants for this paper, Manju Puri from Duke University and Bong Sung-gu of the Korea Institute of Finance. So why don't you take 15 to 20 minutes to make a presentation, Torsten, and then we'll turn to the discussants. Thank you.
Well, thank you very much, Steve. And thank you, of course, for Professor Park and his colleagues for the invitation to present at this conference. So this paper is a certain complement, actually, to the paper that Professor Cecchetti presented yesterday, because it kind of focuses on similar issues, financial innovation, different types of financial innovation, but looks strictly at the empirical evidence of what is out there and what has been the effect of these innovations on different outcome variables we care about: efficiency, access to credit, but also stability. So I'm going to walk through a couple of themes. I'm not going to have all of the literature references here. There is a long list of references in the accompanying paper, which you can look at. So there are going to be relatively few references directly here in the presentation. Now, the first thing I would like to remind us is that financial innovation has been around as long as finance has been around. And if you think just about the last 100 years, investment banks helped the financing of railroads in the US. ATMs in the US started also in the US in the 60s. Ultimately, they were a big part of triggering regulatory changes, moving away from this the state restrictions, geographic restriction on banking, mutual funds, money market funds, but also venture capitalists as a form of investment into startups. And I could go on with this list for a long time. So there has been a long list. There has been also literature kind of looking at these different innovations. There have been very few papers looking at the overall effect of innovation. I have one of them. And there has been a kind of discussion about whether this is good or bad. Is it kind of growth enhancing, this kind of financial innovation, because it completes markets, it reduces agency costs by reducing information asymmetries, or does it actually create new risks, incentives to take more risks, and is ultimately a destabilizing force, an argument that has been made, especially after the global financial crisis. Now, the question is always, is this time different? And one can make arguments that this time is somewhat different. Of course, it's always the question of what is the time frame one looks at, whether it's the last decades or the last centuries. But the digital revolution, most notably, of course, the internet and also the mobile phone, especially in developing countries. I'm going to come to this in a moment. The explosion in available data that has become available, and also the availability of machine learning and artificial intelligence, that really has given way to a new wave of new techniques to process data, for example, to decide on credit applications, to give advice for investment, new products, but also new players. And of course, when we talk about FinTech, we often talk about new players. So for example, there are several definitions out there, but just quote one. The FSB refers to FinTech as technologically enabled financial innovation that could result in new business models. We just talked about P2P lending, applications, so new payment services, processes, or products with an associated material effect on financial markets and institutions and the provision of financial services. So we're looking both at the supply, but also at the demand side. Now, one important difference to be made is incumbent players, commercial banks, also undertake financial technological innovation. That's one aspect. And the other aspect, of course, is new providers that focus specifically on applying this technological innovation to get an advantage over existing firms. So now I want to just very briefly go through some of these innovations. And we talked about some of them already yesterday. I'm not going to talk much about the last one, which is the technological advantage on exchanges, which also lead then to has led to the emergence of high frequency trading. I'm going to ignore this. I have a little bit in this on the paper. But so first, mobile technology, internet, and so on have enabled a much quicker information exchange, new delivery channels, and better exploitation of economies of scale. Now, this is an area which we haven't really mentioned much yet. It was mentioned a little bit yesterday, I think by Antonio. But in the developing world, financial innovation often starts with the idea of mobile money, using your mobile phone to transact for transaction purposes. The kind of poster child here is Kenya with the M-Pesa, also now in other countries, often in many African countries, some Asian countries, basically reducing the fixed cost of providing financial services, reducing the variable cost of financial services, and therefore being able to cater to a much larger population of previously unbanked people. So this is mainly on just pure transaction costs. Now, there's a second aspect, the information technology, so helping to reduce information asymmetries between borrower and lenders, or between insurer and insured, and manage risk better. For example, there are a couple of studies that have shown that just by using your digital footprint, you can predict default probability better than using the information available in credit bureaus. And actually, my discussant, Manju, actually has a paper on that. Insurance, similarly, can be used to better assess the risk of insured people, or also to give better advice for investment purposes. Now, I'm not going to talk much about distributed ledger technology because both Andre and also Antonio yesterday talked extensively about this. Let me just also mention that in addition to the technology and the cryptocurrencies, smart contracts has also been kind of developed as an important instrument in this context. So these are kind of more the product side. but this has this financial innovation has also led to the emergence of new providers. Now, when we talk about FinTech in a kind of more narrow sense, we often talk about small players, often startup companies, focusing on specific services. And payment, and I think we've seen this also in the case of Korea, payment is typically the area where you have where most of these largest, the entrants are attracted to. You have the P2P lending platforms, or in general platforms. I'm actually should not just restricted to P2P, which, as we just discussed, match lenders, investors, or individual, and they have emerged across the globe in different forms. Some of these platforms, although they're not necessarily P2P, have actually achieved quite a high market share, such as Quicken Loan in the US, in the case of mortgage loans, partly also driven by the fact that they can be easily offloaded to the so-called GSEs, so the government sponsors enterprises, Fannie Mae and Freddie Mac. Now, in other countries, such in China, we've seen actually kind of already a boom and bust cycle in these platforms, where the number first almost exploded of these platforms and then has gone down again, partly due to failure and partly due to regulatory clampdown. So typically, FinTech firms compete with banks in specific financial services. They're relatively lightly regulated, and they have the advantage that they're relatively nimble because they're not part of the inflexible organizations as commercial banks often are, and they do not have the legacy problems, the legacy assets, legacy IT systems that banks have. Now, as actually Professor Park already pointed out, they're not really, from competition, they have often gone to kind of being acquired by banks. So there are more kind of synergy effects by now between FinTech companies and banks. Actually, here in London, many of these large banks actually foster FinTech firms by allowing them kind of a lab environment where they can kind of try things out for a couple of years before they either being acquired or they basically are on their own. So this is more like, again, a synergy effect. It's not so much a competition, actually, which this has merged into. Now, very different from big tech, and we discussed this already a little bit yesterday. Big techs are very different from the FinTechs because these are firms that come from outside the banking system offering platform services. And in the Western world, we typically refer to Amazon, Apple, Facebook, Google, but you can also go a step further now and include Uber, for example. You have in China and financial Tencent, but you also have mobile phone companies, Safaricom with M-Pesa in Kenya, for example. I'm sure there are also, there's also actually e-merchants such as Mercado Libre in Latin American countries. So there's a long list. And again, if Leonardo would be here, he could tell us all about this long list. These big tech companies have one big advantage, and which is sometimes referred to as DNA, which actually the BIS came up with this idea, with this kind of acronym, which refers to the fact that they have large data available, much more than banks. They have the network's externalities, for example, think about eBay or Facebook, and they have these interwoven activities. Again, Facebook already having being active in lots of different components of consumer activities, and therefore can use these data, also using then again machine learning, artificial intelligence to go into the credit area. Now, so this is kind of more description, what kind of products, what kind of processes, what kind of providers have emerged. Let me talk a bit about the effect now that these FinTech and big tech have had on the financial system. And of course, one big question is, what kind of competition have they provided for existing banks? And again, as I mentioned earlier, FinTech companies, for example, in the payment area, have often been able to kind of push into this area because they are more cost effective and they're more innovative. than banks. Why is it actually, to answer a question by Professor Park, why is it that the banks don't do this themselves? Well, often the culture is not the same in banks as in fintech companies. So there's kind of, and you can actually see that when you walk into one of these labs that the banks offer the fintech companies. It's a very different environment than you have in typical commercial bank. There's also the question, are P2P lending platforms and traditional bank substitutes, so they compete directly, or do P2P lending platforms complement banks targeting specific market segments? So there are a couple of papers for the US where they show actually kind of using regulatory changes that they are substitutes, but at the same time, there's also some evidence that they can serve as an entry point into the banking system. So once you have a P2P loan, this kind of signals a certain quality. Will big tech companies be able to compete with banks? But on the one hand, they have a higher cost of capital. On the other hand, they have this huge advantage, what I refer to as DNA. But maybe cooperation rather than competition will be the answer that they ultimately will go for. Of course, a lot depends on the regulatory framework. Now, one idea and one issue I want to briefly talk about is the challenges of big data. So typically, as financial economists, we like to think about more is better. More data is better because it reduces information friction and therefore agency problems. So you can include more people into the banked population. However, there's another view, let's call it the behavioral view, that also more data allow financial institutions to better exploit biases among consumers, for example, through targeted shrouding, and of course, it also allows price discrimination. And there's some interesting work by Antoinette Chouard, for example, from MIT, where she shows that credit cards offers are really targeted differently at different population group, kind of exploiting these behavioral differences. Of course, there's a similar issue in insurance, which ultimately might lead to the exclusion of very risky clients if much information is available. Ultimately, this raises the question of the ownership of personal data. Right now, it's basically Facebook or Google or whatever owns these data. There are restrictions now, for example, in Europe. However, the question is really, what should be the best model? There's a very interesting AER paper that just is either forthcoming or came out this year, which basically argues that a world where people own their data and can sell them or can sell the usage of these data would be better than a world where the use of these data is actually restricted. But this is definitely an important discussion for both research and for policy going forward. Now, another big concern, of course, especially for regulators.
About five more minutes about Torsten?
Yes, that's going to be more than. So there's another big concern, and actually this is something that Steve and I are actually both kind of discussing in the context of the European Systemic Risk Board. What are the financial stability implications of this kind of transformation of the banking system? So on the one hand, you can think, and that's kind of in line with lots of long literature, more competition might undermine banks' franchise value and might result in more risk-taking by these banks. You can also think about the kind of opposite hypotheses that if banks are forced out of arm's length transaction-based lending, so mortgage lending, consumer credit lending, where there's a big scale effect and there's really all about hard data, not about relationships, then banks might have a stronger incentive to focus on information-intensive relationship lending, where you can't really go and outsource everything to pure digital footprint. One big concern is if big tech companies start cooperating with banks, what is the model going to be, the compensation model, the profit sharing model? And we know from the global financial crisis that volume-based incentives can lead to aggressive risk-taking. So if big tech companies, for example, serve purely as a platform, they might have incentives to increase the purely focus on volume, increase the number of loans, with, of course, negative repercussions for overlending, credit booms, and then busts. Now, one additional issue that I see is that we know that given the network externalities, big tech companies kind of have this winner takes all advantage. Well, the winner takes all is kind of a phenomenon in big tech and platform companies, and that can of course result in even higher concentration and even more too big to fail. It can also lead to disruptions as the technological landscape moves from one big tech company to another. So we know that, of course, so Facebook was not the only social network. There used to be other ones. I think it was called My Life. But of course, Facebook is not being used by Generation Z, for example, by my kids. So what will happen once my generation and the boomer generation die out? What will be the transition from Facebook, for example, to the next big thing in social networks? So this leads me then to my, I think my last slide actually, yes, my almost last slide. These financial stability concerns, but also these other concerns on big data, consumer protection, lead to regulatory challenges. And we touched already upon some of these. How do you treat FinTech, new entrants? There is a lot of talk about regulatory sandboxes, mixed experience about specific FinTech licensees, but also the question about these ownership links between big tech and banks, for example, but banks and FinTech. We saw yesterday by Leonardo this very nice triangle. There, let me just focus on two of them here. There's a trade-off between efficiency and privacy. Again, more data is always better, but of course, how do we protect people? Similarly, integrity and privacy. I mean, this links back to the whole discussion on blockchain or decentralized payment system more generally. How do we protect individuals? How do we make sure that these transactions are not criminal? And then there's this whole issue on the regulatory perimeter. Yes, in lending platforms, as Steve pointed out earlier, ultimately it's the investor who's liable for the losses. But what about if there are too many investors to allow them to fail? I mean, what if the financial safety net has to be extended to these people? I mentioned already too big to fail issue for big tech. And of course, there's the issue that you have national regulation, but many of these big tech companies are effectively global. And then finally, and I think this was also brought up yesterday, there might be an excessive trust in technology. There's of course all kind of operational risks, but more generally, there is this increased trust and maybe even loss of certain capacity on the human side if everything is just being pushed over to technology. So in conclusions, this is a debate that is just starting, I would argue. I mean, this is going to stay with us for many times. One of the good news for us academics, for us researchers, is that big data has not only enabled financial innovation, but of course also new research in finance. So that's on the good side. One question I want to finally pick up, and already discussed this a little bit yesterday with Javier, is the impact of COVID-19. And as Javier, I kind of believe that this will increase the trend towards digitalization and away from personal face-to-face interaction even more. So it will, number one. Number two is the big tech companies will probably come out very well and with lots of cash from this crisis. On the other hand, I don't think the banks will come out very well. And I mean, it's too early to talk about the banking crisis, but I think we will see a lot of stress and fragility in 21 or in 22. So let me stop here. Thank you very much. And sorry if I went over time.
You went over time by like 20 seconds. Thank you very much for that very good presentation. So as I mentioned at the beginning, we have two discussants. So we'll start with Professor Manju Puri of Duke University. We all have our lovely backgrounds. So so if you could, if you'd like to share your screen, and I think we're about roughly 10 minutes. Thanks.
Thank you. Can you all hear me?
Yes, thank you very much.
Okay, well, first I'd like to thank the organizers for inviting me to discuss this very interesting paper. So this survey just covers so much ground, right? I mean, Arguably, finance is going through a transformation. We know that digital technology and financial innovation has boomed. And so the natural question is, what are the implications? Where is the future going to take us? And if we look here, as I was saying, this paper covers a lot of ground, talks to a lot of important topics. And, this was presented pretty well, right from the movement, from technical to financial innovation, through mobile technology, big data, or distributed ledgers, the new providers, FinTech and Big Tech. And what is the effect of FinTech going to be on the future of finance with its cost of financial intermediation, competition for banks, the challenges of big data, market efficiency, stability concerns, and regulatory challenges. So clearly a lot of ground, and appropriately so, because each of these questions are important. We could take any one of these topics and discuss them for hours and hours and hours. And so, when I was asked to do this discussion, I was, so there's a lot of latitude. And so I figured maybe I'll just speak to a few of these points based on my own research. And I want to raise or highlight a significant positive as well as a significant negative coming from digital technology and financial innovation, which certainly has room for a lot of debate. So here's the positive, if you will, and that is, can FinTech help access to credit for the unbanked? So this is an important problem worldwide. More than 2 billion working age adults don't have access to financial services. It's not just a developing country problem. Even in the developed world, in the US, the FDIC estimates are 6.5% of the US are unbanked, 19% are underbanked. And so for people like this who don't have credit scores or have very thin credit files, does FinTech give us hope, right? And so there's a lot of, in the anecdotal literature, look, there's a lot of, maybe FinTech can enable access to credit to people who don't have the traditional, files or thick files that would enable this. So in work that we've done recently, which just came out in RFS, what we looked at was, we looked at the digital footprint, the bare bones digital footprint that you leave behind every time you access the web. So I'm not talking now of social media or Facebook, where you get a lot of information. When you access the web, you leave information such as, how did I get there? Was it a mobile? Was it a laptop? Was it an iPhone? Was it an Android? Did I put in the website I wanted to go in? Was I clicking on paid ads? What time of the day do I go? And then when you register, what's your email address? How do you type, spell, etc. And so this is what I'm calling a bare bones digital footprint. And that is, I'm not even at this point talking of the larger or the broader privacy concerns of all the other things that you might put up on social media. This is simply by accessing a website. This is the information I leave behind. And so this bare bones digital footprint, we find, is as good as the credit bureau score in predicting default. And the most interesting part, to my mind, is it actually works equally well for people who don't even have credit bureau scores. So this gives us hope, right? And so here's a small diagram. This is just area under the curve. And what you can see is, if you just put the credit bureau score, you get an area under the curve of 68.3%. And this is considered good. Normally, predictability between 60 to 70% is considered a good range, depending on how information rich the environment is. And so the credit bureaus are doing a good job. But my bare bones digital footprint does just as well. It's giving me an area under the curve of 69.6%. And when I combine the two, I actually get, an additional 5.3% over the credit bureau score, which suggests that they are complementary they're not substitutes for each other. But here's the interesting thing, right? And that is 6% of our sample are people who don't even have credit bureau scores, who we call unscorable customers. And for these guys, if you look at the area under the curve, it's actually 72.2%. So you do even better with people who don't have credit bureau scores than people who do. And so this gives us hope that maybe there are ways to bank the unbanked, right? And so technology can be a big positive in sort of leveling the playing field, if you will. Now, balancing that is the negative concern. And that is, sure, technology can be a big positive, but could it also be a big negative? What about discrimination? Which way would this go? Now, in theory, it could go either way. And at least the early work suggests that the evidence is mixed. So the Fuste et al. Find that when you automate loans, it's less likely to benefit minorities. Bartlett and all find minorities are charged more. So the evidence, depending on where you look, it's sort of mixed. So if we think of discrimination, it certainly happens in many ways. So think about the traditional face-to-face interaction. There's plenty of research suggesting that when we're looking at face-to-face interaction, we have discrimination, so there's work looking at the beauty premium, there's work looking at the competence premium. It's not even a matter of subjectiveness. Some people have argued, if you're baby first versus mature, and I can measure your face and make that determination, it's not a subjective judgment, it's actually an objective judgment, but it triggers different reactions, right? And that is, as to who is considered more trustworthy or not. A traditional lender is likely to see a person and make judgments from the appearance. Now, this may not happen in FinTech, where you have, you're just filling in the application online. And so, maybe the face-to-face lending discrimination would not be there. Now, having said that, there's a lot of information that is prohibited by law. In the US, by the Fair Lending Act, you cannot use things like minority or the address to discriminate. But this is not uniform across countries. In Germany, where we did our study, for example, you are allowed to use many of these variables. And consequently, the German credit bureau score is actually more informative than the US bureau score. It's 67 or 60%. And so, but here's the thing, I'm not allowed to use it explicitly, but, could I get to it through the back door, through big data? So this raises issues of statistical discrimination. What kind of data do we allow? And, the privacy concerns were mentioned, and there's a lot of debate about, what data should I be allowed to sell? But even more fundamental concern is, everyone has their websites. We have our own websites. Can I forget about selling it? Can I just mine that data myself to make decisions about people approaching my website? Now, as per the law in the US, you can use data so long as it's for a legitimate business decision. What does that mean? So that means you can score on credit risk, on macro fundamentals, etc. And so this allows scoring on big data variables that might correlate with ethnicity through hidden fundamentals, but it doesn't allow big data variables that have residual correlation after orthogonalizing to these fundamentals. So let's consider high school, right? So high school in the US, it might, correlate to area, income, etc. Now, if you orthogonalize on income, if there's a residual correlation with minorities, then high school is going to pick that up. And so even though you may not explicitly put minorities there, you sort of have another variable that will get you there through the back door. What we've seen in these P2P lending platforms is the area under the curve is actually growing over time, right? So these are getting better and better, at sorting out and distinguishing between credit quality. And clearly there's a lot of learning going on, just looking at the data and figuring out what variables matter. And variables you might think have no relationship actually matter. So for example, in our barebone digital footprints, we find people who show up between midnight and 6 a.m. actually have higher default rates, right? And so from a statistical default perspective, clearly this is something you should put in. Now you might ask, does this pass the legitimate business purpose test? On the face of it, probably. But I could always invent stories by which it doesn't, right? So what if minorities are working at night shifts and therefore they're the ones shopping from midnight to 6 a.m.? In that case, even after orthogonalizing on income, I might actually have some residual correlation. And so, even if we have a law that says, okay, we'll restrict how much big data you use, and we won't allow, after you orthogonalize to sort of hidden fundamentals, there shouldn't be residual correlation. But who observes this correlation? Can regulators observe this? Do firms even know this? Do they measure it? They may not measure it. They may choose not to measure it, or they may not even know about it.
Could I ask that you wrap up soon?
Yes. So what is the right policy response? Should we impose more controls? Should we ask that the correlations be made explicit after orthogonalizing? Or do we allow playing around to determine the right model or the sandbox approach? I think all of these are, legitimate questions. So overall, it's a fascinating area. This just raises so many important issues, and it's important for multiple players with its firms, consumers, or regulators. So thank you.
Thank you very much. We will now go on to our second discussant from the Korea Institute of Finance. Dr. Gu, would you like to share your screen or just have comments?
Be a discussant for this wonderful, probably illuminating paper. Since I'm really a newcomer to this topic, probably my comment rather be questionnaires rather than real comments. I will. Okay. When I read these papers, I understand that professors really talks about all the issues related to the digital finances. But I understand probably he wants to emphasize probably substantial benefits from the FinTech innovations. Also, I'm really interested in how this distributed ledger technology will affect the financial market, especially like ISOs, B2Bs, or some of CBDCs, or even the functioning of the intermediation itself. Probably in the long term will have a significant difference landscapes in the financial market. Second, I understand he really interested in the big tech and big data issues. We know the big techs are quite different from the fintech. Already in the payment market, big tech is really changing the competitive landscapes. Already is really entering into the banking business. Historically, actually, the payments was not real. Some country really included in as a basic function of the banking business. But now, you really payment is not a really banking. Is some kind of just commercial services. But is kind of changes, I suppose. Also, big data is Professor Fury mentioned that it has quite an intrinsically positive and negative impacts. But certainly, using big data will provide more new innovative products and also probably more targeted and tailored services for individuals or maybe small businesses. And last, I think in terms of regulatory perspective, Professor Beck discusses a lot of regulatory schemes like regulatory sandboxes or licensing schemes or some kind of safeness issues. In general, when I read this paper, the Chinese cases are rather exceptional outliers. Certainly, we are really quite a gradual process of accepting the financial innovations driven by the technologies. But China is really making new leapfrogging stances in terms of policies. Also, sometimes we see the failures, but sometimes we have success, but still they are very open approaches. Also, I think we have to look at the data, whether data really useful for the consumers or customers, or is it really exploited by the big techs or others. But certainly when you're looking at data must be used as for the other purposes, like maintaining integrity for client, or maybe verifying the source of funds. So data is quite important. When I say data, is in data format rather than just data we are normally using on papers. Also, the Professor Beck really raised the issues about the concentration, not just concentration in the market and services, it also is concentration in IT technologies like cloud and computing or information sharing. All these stuff is actually related with big data and big techs. So my next area I wanted to lead to is actually the questions. When I read this literatures of the data finance, I'm really interested. The question is why fintechs and big techs are so more active in banking services. Traditional banks are too special, and must be something different from other like security services or insurance services. But certainly when the communication technology developed, these big techs are provided very small part of the banking service, which is the payment. But payment becomes more prevalent, and in terms of economics and economy and in the society in general. But probably banks did not really do much of investment in infrastructure because they're based on the branch banking. So, but for the developed countries, probably this communication technology or infrastructure is very easy to adapt this payment services on the top of this telecommunication services. Also, the banks were not really interested in the developing new business, even if they do mobile banking, sometimes internet banking, but they are very gradual because of so much of regulations. And when you do something new, you must pass through lots of regulatory hurdles. And also the banking sector was very somehow protected from competition because so much we have a crisis, a lot of prudential issues, also market becomes more concentrated because of mega mergers or etc. So I think bank was very special, but certainly if you're looking at the technology innovation, it's not very special. Also, we see when as mentioned, before payment services was really a part of the banking service, especially retail payments. Even retail payment was backed by the large value payment. But certainly after the digital revolution, regulators are very distant from the old, advancing this payment advancement. So I think there's some regulatory loopholes somehow. Also, the loans are becomes more commoditized, and also the consumer credit is much easier to access. So in a sense, market becomes banks becomes less special. Also, the third one is if you are really big tech companies, especially you have marketplaces like Amazon, you're inevitable to tie the payment with the merchandising. So basically, they are very clever somehow. Banks was more focused on their own business. They're closed, the culture is very closed, very introvert. But these all big tech companies are more outward and probably trying to utilize their own platforms by using financial services, especially payment services. It's, in a sense, payment is just like a natural extension of their own business, I suppose. Also, they have more information advantage because their infrastructure is more digitalized format, so they're easy to collect the information, I suppose. The second question is, really we talk about data, but when how much is this digitalized information valuable in reality? We see the lots of conflicting evidences. Some are very good, some are very discriminating, but who is going to be really winner at these questions? Big techs are very they are very good at utilizing augmented data, but data is a very soft. There we have so much of a superior relations with the different variables, but banks are more using hard data. They are more verified data. So they are not very interested in using soft data. Even if we see some of causalities in soft data between soft data, but I don't think that they are really acceptable statistically, or sometimes as a really evidence for the differentiating credits at grade or other, or using in the deciding the loans. Basically, these issues must be purely take account of it, because all the data must be viewed as in terms of interest of the consumers. Otherwise, we can't find any solutions. That's my questions. Third one is this is issues. First, SECA in general finance information recently raised the issues. Probably how we understand this digitalizations in financial service, or big data, big text, or other DLT technologies. I suppose this is a finance market becomes more non-intimidated. Even in small business banking, we see a lot of direct lending market, even if there's a high cost of borrowings for the borrower, but still we see a lot of financial market becomes more broker type institution rather than dealer type institution. In a sense, traditional banks rely on the public trust or leverage. Because of leverage, they have to keep even public trust. But if you do not have intimidation rules like a dealer on the screen, but they don't much interest in caring about depositors or suppliers, because they don't need to their own risk management or their own reputation management. So probably we should make some questions. If your financial market becomes more and more non-intimidated, who will take stability responsibilities? Is it just part of central banking, or is it to be taken by the deposit guarantee institutions? I don't know. This is some question. Fourth question will be, I will go forward, but and still what the banks will be still remain in special in the data age. Probably I think they will still special because of liquidity creation, but still if our society becomes more cashless, banking becomes no branches, and there is a lot of cross-border banks, and stablecoin becomes a new basic currency. There's a lot of data identity innovations. Then probably banks, what's really banks are special? In what sense banks are special? This is another question. Finally, I wanted to imagine what's the future of banking model. On the screen, this is a rather old one, but it's presented by the Deloitte in 2015 for the Swiss banking federations. I see if you see this value change on front side, probably more the big techs will take this responsibility much more easily, and product development more taken by the more specialized fintechs. On the other side, probably take a traditional big banks. So I suppose banking sector will be more distributed or reorganized, but still big banks or universal bank will survive. So in a sense, big banks may not need to fear too much about the
big techs, because big techs are more focused on the front offices rather than the back offices or middle offices. Second conjecture I have is banks may be faced with a higher regulatory requirements because banks become large and large. Also, presumably the big techs are not likely to have a banking license because of so much of regulatory burdens. So, but certainly large banks will take third-party risk or some about for consumer protections. So possibly regulate costs for banks may increase even in digital age. And as I said,
wrap up a bit.
Okay, this is the last page. Okay, thank you.
Thank you.
Okay, my conjecture is banks should remain very special to maintain financial stabilities. If you have a more non-intimate market, lots of self or private networks, probably there's something happens. Probably who will take these stability rules? Even if central bank provide liquidities to these private institutions, but why? That's a very questionable. So I think we must have a more tourism banking system need to be ring-fenced as a social infrastructure. Otherwise, we have a more fragile finance systems. The last one is, I think, future policy must be or should consider the issue of the independence role of the financial services. If going back to the 1930s, we have lots of issues because of combining commerce and the banking services. Even if the big tech companies do not really do not play a crucial role in providing financial services up to now, but certainly we see the lots of connections between the consumers, merchant, and commerce and banking or payments. So we must should discuss about these issues, whether to preserve stability or consumer protections, whether we have to maintain this historical principle of separation between commerce and banking. Okay, thank you.
Thank you very much for that very comprehensive and interesting review of the paper. Are there any other questions or comments? And then I will turn it back to Torsten. Antonio?
Yeah, I just want to do a small comment because I mean, I sort of agree that the power of big tech can be a big disruptor in financial markets, and we've seen it in some countries. At the same time, if you look at some other regions of the world, whether it's the US, whether it's Europe, I mean, big tech has not gone very far. I mean, if you look at Amazon, if you look at Apple, if you look at Google, they're sort of partnering with banks. They're doing a few things here and there. But if you look at the current plans, it's not obvious 5 years from now whether they'll make a big dent. And I'm not sure whether it's just that banks are a lot more powerful and sort of bank deposits are very sticky in these regions. But I find it interesting that we all worrying a lot about big tech, but when you look at the evidence in some regions, it doesn't seem to be getting a lot of traction yet.
Thank you. I have the same reaction to big tech in much of the advanced world. I guess the only question is whether or not they're going to go beyond partnering with banks and start to buy them, and that would be something different. And if you think about, so for example, the reason that you would do that is because you want the regulatory compliance operations that are inside of the banks. They know what they're doing. In the United States, banks that want to operate in different states of the United States buy banks in those states because they have that. They have the ability to operate there already. Anyone else? I have one comment, which is maybe more related to what Professor Puri said than to what you said, Torsten, and that is, I wonder about, maybe I think this may have been what you said, but I may have missed the implications. One of the big risks, as I understand it, of machine learning and artificial intelligence uses of data is that you basically turbocharge the biases in the training data set. And so, in fact, the problem is not necessarily getting away from discrimination. It's actually enhancing discrimination that's hidden discrimination, that people have found ways around. I think, as you pointed out, you can find proxies for certain things that are not allowed by law in various jurisdictions, but you end up with machine learning technologies that actually accentuate those. And that this is a bit different, I think, from what you have in your paper, Torsten, which I'll talk about in a minute. But did I miss that?
No, I mean, that's exactly right. I think that's exactly the point I was trying to highlight, and that is that indeed, technology can be good or bad. You might not have the face-to-face discrimination. I look at you and I don't like you because of your color or gender or whatever. But, with big data, you can do a lot. And so all these variables that you're not supposed to employ, you can find backdoor ways of employing them and doing a pretty good job of employing them. And so that is certainly a matter of concern.
Thank you. Torsten, would you like to react to? You have lots of comments, maybe a few minutes.
Yes, so thank you very much for both discussants, for the excellent comments, and also for the additional, in the case of Manju, for the additional references. I don't really have any comments directly to the discussants. I think they were very, these are all open questions, I would say, or many of them are open questions. And I really like, for example, that Manju was kind of pointing to these, again, giving this specific example of how big data can be positive or can be negative. So there are both dimensions there. And of course, the big implications are really for regulators in the area of consumer protection, for example. Maybe less, in this case, maybe less than financial stability. So I think with big data, maybe that's the bigger issue. Now on Antonio's comment, maybe very quickly. So yes, maybe we're exaggerating. Maybe we are kind of dreaming up or nightmaring up a scenario which will maybe never happen. I don't know. But I think there are, and it's certainly, I think over the last year or so that I've been thinking about this issue, I think it's not really likely that big tech companies by themselves, so these platform companies by themselves, will kind of turn themselves into a bank and then basically soak up the market and become the big provider. So I think the issue is more, as Stephen pointed out, that they might actually buy up banks. And then the question is, for example, what about consolidated supervision? Yes, you would then basically, you have a bank subsidiary, you would supervise the bank. But of course, we know that there can be things going back and forth, both in terms of capital, in terms of profit losses, but also maybe also reliance on certain infrastructure such as data again. So I think that's more of an issue about what will be the role. And I know that Javier is just turning on his camera, so I'm sure he will make a comment on that, because he's been also thinking heavily about this topic. So, but I think this is more the issue of what will be the role of big tech companies in the future of banking and the relationship with banks. So I'm as much worried about the form of a possible cooperation between banks and big techs than about direct competition, and maybe even more about that. Thanks, Javier.
Javier, did you want to make a comment?
I want to add something. I think I agree, with what Antonio and you, Torsten, you were saying now. But I think the key question that we have to ask ourselves is, in 5-10 years, or maybe more than 5 than 10, who will distribute financial products and services? That's the key question. And I don't have the answer, but I'm suspect that there will be a kind of a little bit of a battle, between the incumbents and the platforms, because the platforms have everything to do it.
Right. I think it's like, this is.
The question is what form. The question is what form. Whether third-party services, own services, with a bank subsidiary or not. And all this will depend a lot on regulation. But the banking is moving to be like all the other businesses, in a sense, all these retail type business to a platform-based business. I mean, this looks to me that it's going to happen, no? So that's the question.
So I think that one way of putting your point, Xavier, is that Amazon doesn't actually make anything, right?
No, but now it markets its own products also.
Right.
And
Now
that
but I'm not sure it actually makes those, but it doesn't have factories, right?
No, it doesn't make them. No, it doesn't make books. No, but or what?
It's
No,
stamps.
I mean,
No. My point is your point is that there are a bunch of people supplying products. They have a platform, and we all go to this. I don't know. I go to this platform all the time, and we then grab them off of their platform, and they deal with everything else, right? We don't know. I have no idea what's going on between Amazon and the person that actually makes the product. What's going on there? That's their business, right? So the question is whether financial services. I read your very interesting paper, which you summarized yesterday. I read your paper as saying that's the fundamental question: is where are we going to be? Who's going to be doing that?
That's kind of. I think that's what a big difference is here between goods and services, and intermediating goods and services, and intermediating as a platform, financial services, is in, of course, the incentive structure, right? So, for example, if Facebook gets compensated by banks on a loan basis, they have the incentive to push out as many loans as possible. And that's a bit what we saw in the global financial crisis, where it was Washington, Newton, I think, where it came then out that one of the banks basically paid their loan officers really by the number of loans. So just push them out as much as possible, as if tomorrow didn't exist. And of course, that can have very important implications for financial stability, even though these platform companies don't hold the loans; they're all on the bank's balance sheet. So I think that's more.
No, but you're right, Torsten. But there are some countervailing issues here. Factors like it is that if the big techs or these platforms themselves get involved into supplying the products, then this changes. You see, it's like Amazon. Now, Amazon, you can buy products, third-party products, or you can buy the own Amazon-sponsored products, and this is different. And the impact and the thinking in terms of the quality and the impact in the market is different. So I'm just saying it's open. I mean,
I think where the platform firms do not go directly into lending, but really provide this kind of platform service where you have borrowers on the one side, banks on the other side. Now, if they go directly into
I agree with what you say.
Okay, I think Professor Park has a comment. Did you? No. Okay. All right. I think this conversation can go on for quite a long time. Are there other comments that people have? I have. I guess it's my role to provide a conclusion at some level. I've written out a long one, which I'm not going to read. It's way too long. But I'll start by saying that I think we've had a very nice 2 days of presentations and discussions. And we've talked about, I think, extremely interesting issues in detail. I hope that our hosts in Korea feel that this has been a success and provided them with the information that they believe that they need, at least a start on that. Of course, there are two related questions here. One of them is as Torsten said at the beginning of his presentation a few minutes ago, is this time really different? And I'll say that Xavier pointed out that this time might be quite different. Yesterday he pointed out it might be quite different because we're turning soft information into hard data, and when we turn soft information into hard data, it does seem to change things. I will point out there was an issue that keeps arising as to why is everybody trying to enter finance. I think that's a pretty easy question to answer. It's where the money is. And just to give you some sense of how much money is in finance, finance seems to have value added, which means that that's the return to finance of something on the order of 3 to 4% of GDP on average around the world. And so that's a number like in US dollars at market prices, sort of $3 trillion around that kind of number per year. And so if you don't have to get a very big slice of $3 trillion to make you pretty well off. But the interesting thing, I think, from our point of view, is that that there's been an explosion then in the use of technology. It does seem to be happening. It does seem to be happening more rapidly. I do worry that that's our perspective. Whenever I think about how fast things are happening, I think about my grandfather, who was born in the 1890s in Germany and passed away in 1982 in California. And he was born into a world without cars or airplanes or zippers or Velcro or any of the things that many things that we take for granted. And these all occurred during his lifetime. During our lifetimes, we've seen quite big changes as well. There are changes that are occurring now. So the question then is where is this all going, and what is it that regulators should be doing about it? On the regulatory side, I think that there are some extremely important issues that need to be answered. We need to actually face. We have to make sure that we encourage entry, maintain resilience, and safeguard compliance all at the same time. We need safety and soundness. And if these are successful, if we're successful in all of this, then costs of financial services to final users is going to fall, and access is going to expand. We do need, I think, though, substantial government support for some of these things. Professor Puri mentioned the unbanked. The unbanked have been dropping dramatically. One of the big reasons that the number of unbanked has dropped dramatically is what's happened in India, I think your home country. And what's happened in India has been government sponsored. You can decide how you feel about it, but the fact that there has been the creation of a personal identity system, Aadhaar, combined with the provision of no-cost government-sponsored bank accounts, those two things have conspired to increase the number of people participating in the Indian banking system. Again, you can decide how you feel about it or how important it is or how big it is, but the gross numbers are roughly 400 million people in a period of 5 years. It's the most amazing thing that I think the most amazing example of financial inclusion that I can find. Again, we can decide if those people are really included, how much they're using the banking system, but it certainly has provided some substantial opportunities. Now, without going through the details of what everybody has talked about, we had discussions at various points about how to frame public policy. Leonardo Gambacorta gave an excellent discussion yesterday. There was Andrei Karolenko's discussion of cryptocurrencies and blockchain and distributed ledger technology. This is a technology that I have to say that it's been around now for a while, and we're still trying to figure out, in my view, what to use it for. I think there will be forms that we're going to use it for, but as I suggested, there's a lot of role here there are important challenges, and here, as was the case with Torsten in the discussion of the very nice presentation by Professor Park at the beginning of today's session, I have a series of questions, and so the first question is, how much infrastructure does the government or the official sector need to provide to facilitate improvements in finance, to ensure that the innovations meet the requirements for for inclusion, for safety, and protection? Will they support and maintain, for instance, digital identity systems? We need digital identity systems for a lot of this. Identities, as I suggested, for individuals, firms, for institutions, and for financial instruments or securities. Some of that is underway. And in some countries, I can say that I am sure there will be tremendous barriers to personal identity systems. What are we going to do about data protection protocols? This was a discussion that came up obviously in the last case, but I think has gone throughout all of this. Issues of who is going to own the data and who owns our data. There already are these dramatic differences across jurisdictions in who owns personal data. My hope is that we go more towards, around the world, the European system, in which case I think we're going to all end up with a new supplier of services, which is we're going to have data custodians. And we're going to hire data custodians to take care of our data and to curate our data and then to offer us fees when people want to buy our data or want to buy slices of our data. What are we going to do about cybersecurity strategies? Cybersecurity strategies, and this is, I think that this came up briefly yesterday when there was a mention of the concentration of cloud computing services providers, of which there are really only about 3. I think that Torsten mentioned briefly this morning already, or this afternoon or evening, the fact that there are huge operational risks associated with these technologies. We have to worry a lot about the fact that we seem to trust these technologies in ways that maybe isn't so smart. The next thing is about central banks. Will central banks provide retail digital currencies that we can all use? And will they provide a retail payment system? Antonio emphasized that the tie between mediums of exchange and currency and payment services, medium of exchange, as he pointed out, are basically useless without payment services, payment systems attached to them. The way I think about this is that money is both a technology and a legal system or legal structure. It's those two things kind of glued together. And what those generate is payment services as well as stores of value and all this other stuff. And there's also a question, I think, in a lot of jurisdictions of whether or not government is going to support the financing of fintech businesses. It's one thing to say that you regulate people. It's another thing to say that you provide information, but it's a third thing to say that you're going to go into business with them. And there are not just fintech sandboxes and innovation hubs, which are the first 2, but there also are accelerators that are government sponsored, where you actually have public-private partnerships and government support, direct support. So are we going to do this? Are we going to do it directly? Or are we going to just do it through tax subsidies, or both? And then finally, questions that came up, I think, in our discussions, especially of what was happening, of some of the problems that our Korean hosts have faced, and that is how regulators, supervisors, and competition authorities are going to treat these firms, not just the startups, but also the incumbent firms. And I think these are all very important questions. The presentations over the last few days, I think, made clear that the answers to these are going to guide how the financial system evolves over the coming years, and that the answers are not obvious. But they will differ across. I think, across jurisdictions and over time. And so that's going to provide research opportunities for all of us, and it's also going to provide information on how to go about it. I will stop there and see if Professor Park wants to have a final word.
I have a few questions on your some of these issues. The investment in infrastructure development. Well, to what extent private sector can participate in this process? This is my questions. And then the things like digital identification, data protections, cybersecurity. Well, I mean, the government must do a lot of things to provide, to make sure that these important the aspect of digitalizations cannot hurt the stability of financial markets. But then our experience is that when the government participate in providing the cybersecurity, digitalization of data protection, they always attach some sort of regulations. I don't know why, but then these protection comes with a certain amount of protections. This is the problem. And then the central bank, the Korea, I understand, is going to issue a digital currency beginning next year. And the question, I mean, even the United States is not planning, to my knowledge, introducing a digital currency. Is it for a country like Korea? Is it too early to introduce digital currency or not? And finally, the government support of FinTech. Well, they haven't thought about it, but they are going to think about this the private sector, government, the cooperation on many fronts. But then these are the issues that we are going to deal with. But then finally, this is the question on which I would like to have your responses. That is, the regulatory authority has been keep adding new laws and regulations to the pre-existing regulatory system created for incumbent financial industries, legacy financial industries. And in so doing, they have created regulatory uncertainties and regulatory arbitrage opportunities. And at the same time, in this process, they have been very reactive rather than proactive in dealing with new risks arising from the growth of rapid growth of some of these fintech firms. So that what we are trying to resolve is, how are you going to minimize these problems when you are dealing with regulation of fintech industries within the existing the regulatory system? And the one question is that whether it is feasible to establish new regulatory systems for the fintech industry, independently of the or not independently, but in addition to the existing the regulatory system. These are the questions on which I need your suggestions and recommendations.
Well, I'm sure everybody here has their own answers to these questions. I guess we can go around and if you can, hopefully everybody sort of took a couple of notes, and if you have one or two of them that you'd like to address, I'm sure that they would be happy to hear your answers, and I guess I can clean up at the end. So Torsten, do you want to start? I can go in some form of alphabetical order. Go ahead.
Yes, thank you. So I'm not going to talk about a digital currency because Antonio is on the call, so he can take that one. Just on the regulatory framework for fintech companies. So I'm a big fan of, I guess most of us are big fans of regulation by function, not by name. So having a separate regulatory framework for institutions, for a specific type of institutions, just for the sake of it, I don't think that's a good idea. I mean, there is a case, if you can make a case for it though, if you think about if fintech companies offer very specific services, for example, they're only active in the payment space, then yes, that would make sense. However, if they are full-fledged intermediaries, there should be no difference between how they are regulated and how commercial banks are being regulated. So I think it's more an issue of maybe adjusting the regulatory framework according to what risks do these institutions pose for the general public, for the depositors, for investors, and for the system as such, rather than saying, oh, we need a specific framework for specific new or incumbent or old or young types of institutions. Thanks.
Sorry, Steve, you're muted.
I think Javier, you want to.
Oh, I'm sorry. Antonio, would you like to go next?
Yeah, I'll just say a couple of words about central bank digital currency. I mean, it's not a question whether it's too early or not, because one could create central bank digital currency with the right framework, and there's nothing wrong to create it now as opposed to waiting. At the same time, I think central banks are a little bit rushing too fast into the idea that creating this asset or this liability on their balance sheet that everyone has access to is the solution to many of the questions or the issues they're raising. I think the issues they're raising are not, at least in my view, about the existence of a public asset or a public liability to which all we have access to. I think they're more on the payment side, the efficiency of the payment side, the inclusion of the payment. And this is much more about sort of the pipes and the plumbing on the payment system, because we've seen around the world solutions which are entirely driven by the private sector that work very well. They can be very efficient, and it's unclear to me what the addition of central bank digital currency would do for that. And I'm not saying it cannot be a solution, but I think central banks, at least in my view, they're simplifying too much the problem and obsessing about the creation of these currencies as opposed to understanding the implications they have on the overall payment system.
Thank you. Manju, you're next if you'd like to take any of them.
Sure. I'll just briefly comment on the regulatory framework for fintech companies. And I think one of the points that I want to make is you need to distinguish by the services that are offered. So you have like standalone fintech companies, and you could think of, the big companies where you marry e-commerce with financial services, which is a very different kettle of fish. And one way of thinking about this is go back to the old debate, like in the US, Walmart applied at least twice for a banking license and were turned down because of concerns of marrying commerce with banking. And so to strip away the big data and technology part for a moment, this in itself is a concern, right? So when you have these large e-commerce companies, be it Amazon, be it, Flipkart, depending on which country you're looking at, there is a question: do you marry e-commerce with banking, right? And then the second part that you layer on top of that is all the big data issues, because now I have so much more information through my e-commerce arm that I didn't have elsewhere. And so then all the traditional concerns that we have, even absent, big data, everything, which is, monopoly and all these other concerns, they're heightened or, from this big data angle. So I think this is something to keep in mind, right? That whatever arguments we had for, good or bad, and there are certainly positive or negative arguments for e-commerce marrying with the financial services, you want to separate that and add to that with the big data angle. So.
Thank you very much. Xavier?
Yes, also on the regulatory angle of how to regulate fintech, I would go back to basic principles. Do not do anything special for fintech. That's what I would do. That's to say, I would keep the principle that maybe for smaller players that are not systemic, do have some regulatory treatment, which is lighter than for players that may be systemic. Okay, and that I think is a basic principle. And then obviously, if large e-commerce or big tech firms enter there and may be systemic, so then they will have to have the same regulatory principle applied to them. So I am typically against special, when something new appears, changing the rules. It's like now we have to change competition policy rules because we have the big techs around. Well, I would not rush to do that.
Thank you. Let's see, I'll make a few comments. First of all, picking up on what Xavier just said and Anju, I think that be careful, always be careful with forbearance, even briefly. If the idea is to get people to meet certain objectives more cheaply, relaxing constraints is not the way to do it. So I think that forbearance is something to worry about. Lighter regulation is different, though, in some ways. So I think that but again, I would not compromise on the ultimate objectives of safety and soundness, things like consumer protection and anti-money laundering and preventing and countering terrorist finance and the like. I would not even come close to compromising on compliance issues like that. You just can never do that. You can't allow people to have different accounting schemes and different reporting schemes just because they're new. That seems to me to be ridiculous. For the record, I would have given Walmart their banking license, but then they didn't ask me. But I think that's a completely separate issue. On the infrastructure question, I think the infrastructure has to be sponsored by the government. Infrastructure is a public good. Maybe there are going to be private returns to it, so you can figure out ways to get the private sector to pay. But we do have we have this thing called the legal entity identifier that was created in the aftermath of the financial crisis of 2007, 2009. It's yet another one of these Basel-based organizations. It's not under the BIS, but it is something that came out. They did want us to do it when I was there, but we refused. It comes out of the Financial Stability Board, and it is a global effort. So I think the more important thing about the infrastructure is not that it be it does need to be a government, but it needs to be a globally cooperative effort for it to work. And they are working on the security side of this as well. The individual one, as I suggested, is going to be much, much harder. And I also want to just say that I agree completely with everything that Antonio said about central bank digital currencies. No one has made a compelling case to me about what problem this solves. Now, maybe there's something out there. I agree. And I agree 100% with him. I think there are a lot of risks to doing it without solving problems. And I agree completely that if the issue is payments, then worry about payments systems and the pipes. If the private sector, public sector, which is a cooperation already on the payment system, is not working to deliver what you want it to deliver, what society wants, then figure out how to solve that problem. Central bank digital currency is not the solution to a payment system problem, at least not as I understand it. It is a risk, though. It is a big risk to a lot of things. Now, there are platforms being created for wholesale central bank money, but we already have wholesale digital central bank money. So this is just going to make I think cross-border transfers easier. But there is a lot of stuff going on at the BIS in their innovation hub, and the Bank of Korea is very much plugged into that. So I think, I don't know if we answered all of your questions. I think we gave you maybe partial answers or the starts of answers to some of your questions. And I'm sure this conversation will continue.
Well, no. The last one, this digital currency. So would it be prudent for us to wait until some other countries' experiences, what they say, what are the risks or the advantages, benefits of introducing digital currency? Wouldn't that be prudent instead of rushing into creating a digital currency, for instance, next year, as it planned in this country? I mean, simply because the Chinese have introduced a digital currency, that doesn't mean that we have to follow their example, for instance.
Antonio?
I mean, I don't think there will be any harm in waiting. So yes, waiting is an option, but I think the reality is if you were to launch a digital currency by the central bank next year, it will be launched with incredible constraints about who can hold deposits at the central bank. There will be limits, and a lot of the risks that Steve has in mind probably can be managed. So again, I assume those risks can be managed by constraints on balances, et cetera, So it might not be a big crisis either, but if you ask me, does it make sense to wait? Sure, because as Steve said, I don't think this is a solution to any of the potential problems.
Right, I agree. I would agree with that as well. I think there's certainly no harm in waiting. China is a very special case. Remember that China has capital controls. China has very large state-owned banks, and China also doesn't have the same view of privacy that other countries do and other societies do. So if you're willing to give up on privacy, if you don't care about the potential disintermediation of your banking system, and you have capital controls, go ahead. Nothing bad's going to happen, and you're going to find out if something good happens. If, on the other hand, you're concerned about the potential for disintermediation of your banking system, for the possibility of criminals getting access to this stuff, and capital flow management, and you're worried about cross-border capital flow management, then this stuff can make things worse if you're not careful. And I think that other countries are working very hard to solve these problems, and countries that could become a model for Korea, like Switzerland. Okay, Switzerland worries about all of the three things I described very much, and they're trying to figure out ways in Switzerland to launch a digital central bank currency at the retail level right now. And maybe over the next few years, they're going to solve these problems. And if they do, and if they have a model, then there will be an example for the Koreans to follow. And they're not the only ones, I should say. I mean, they're just one that I would look at and say, okay, if they can figure this out, then they're going to have a pretty solid example for you.
Okay, Steve, can I ask you just one more question? You know that in our experience, this cyber protections, cyber security, the consumer protections, and data protection, these require new and a large number of regulations. And then there must be some sort of trade-off between regulation on the one hand and the benefits from protection of these activities. I mean, how do we balance the trade-off between the two?
That's a good question. I don't have a good answer to that, and I'm not sure. I don't have an answer. Other people have thought about this much more than I have, so I don't know if anyone else wants to try.
Okay, Andre would be probably the ideal candidate to answer that question. But cyber risks are a big concern, and I think it's partly again coming back to the unknown unknowns, right? We don't even know, I think, what kind of risks are out there in the cyber risk space. I mean, we've seen some of it, but I think there's much more. And like, for example, cryptocurrencies are going to increase in their role. I think new types of risks will pop up that we're probably not aware of yet. So
I think we're going to have to. Oh, sorry.
May I? Sorry, Stephen. Just 30 seconds on the cyber risk. I think here we should distinguish between conduct regulation and structural regulation, and because it may well be that some of these cyber risks may be mitigated with structural regulation. That's to say, with stating, for example, that some banks cannot depend exclusively from one provider of IT services, that they have to have a backup, or that they have to have at least two providers. So and the structure of the industry of providing these services also matters. No, that's the only point I would make.
So I think the other point I would say is that you're not alone in worrying about this. So again, there's a lot of I think that there's a lot of benefit in cooperation and information sharing. I think some people are going to have to go. We've gone over our time, and people have generously stayed. So thank you very much. We lost some people earlier, but I think we'll have to close. Is that okay?
Well, it's okay. And on behalf of KIF, Korea Institute of Finance, I would like to thank you all. And we have learned a great deal, and what we learned will help us improve our paper and contribute to the understanding of fintech industry and what these regulators are going to do in the future to foster a fintech industry in a orderly manner in the future. And thank you very, very much. And Steve, would you make a last few comments, concluding comments?
Oh, I think I did already. So
okay.
I do that already. Okay. All right. Thank you very much.
Thank you very much.
Bye-bye.
Thank you.
And have a
Bye.
good evening.
Thank you.
Okay, so I'm sorry about that, Young Chul. I guess I did things in a bit of a different order from what you expected, but I hope that that was something that you all found useful and that it met your expectations.
More than our expectations. It's very stimulating.
Okay, so I guess
thank you very much.
yeah, and so I guess everyone will be in touch about where you wish to go next with the material from the conference.
Okay.
Okay.
Yeah,
Okay.
thank you.
Bye-bye.
Bye.